Hi everyone. Today we have Rohil speaking on auto ancillaries. He tracks auto and auto ancillaries sector at PPFS, and he'll be debusting some myths and some misconceptions that some people would have. So I'll hand it over to Rohil.
Thanks, Raj. Good evening, everyone. So we'll have a look at the auto ancillary space today. But before that, just a disclaimer. So during the presentation, I'll be talking about various different companies in the auto ancillary space. So I've just used them as an example to make the point. But none of them are buy, sell, or hold recommendations. So this picture is actually speaks volumes quite literally, because it shows the number of parts that go into a single vehicle. The estimates are that about 30,000 parts are used to make one single vehicle, and this includes each and every nut and bolt that goes into the this includes each and every nut and bolt that goes into manufacturing the vehicle. While there are 30,000 car parts, there might be about 1,800 unique parts that go into the vehicle. So ever since I started covering this industry, there are two questions that keep coming up every now and then, whether it's a question or a debate that continuously is there. So I wanted to try and understand, and this is something that I've continuously been learning about. So the first question is, the auto ancillaries generally have no pricing power. And why is that? Is it that the OEMs are just squeezing the auto ancillaries for more profits? Ideally, that would make no sense, because at the end of the day, the auto ancillary is part of the supply chain, which is critical to the entire operations of the automotive OEM as well. So they need the auto ancillaries to also be profitable so that they're in business for longer. So then why is it that there's a notion out there that auto ancillaries don't have any kind of pricing power? So one of the data points that I have been looking at is the EBITDA per unit for be it the four-wheelers or the two-wheelers. And when you have a look at this, so in blue you have Maruti Suzuki, and in red you have Mahindra and Mahindra. Mahindra and Mahindra includes a standalone business, which is passenger vehicle and commercial vehicle, because they don't break that out. If you see these numbers, the EBITDA per vehicle actually has been a bit cyclical in the last 4-5 years, and has come down from the peak of about 67,000 to about 34,000. So even a mere 1,000 rupee saving can actually increase their EBITDAs by 1.5 to 2% per vehicle. So, and considering it's a volume game at the end of the day, it makes a big impact at the bottom line. And then looking at the same data for two-wheelers, the figure is even more pronounced, because the average EBITDA per unit is about 5,000 to 10,000 rupees for the three more mass market kind of two-wheeler companies, except for Aisha. So 1,000 rupee saving per scooter or per motorcycle can actually lead to 5 to 10% increment in their EBITDAs. Just for the Zoom audience, I was talking about the EBITDA per unit and why there's no pricing power for the auto ancillary companies. One of the reasons could be that the EBITDA per unit for the two-wheeler companies is actually quite less, and mere 500 to 1,000 rupees saving per vehicle can actually help them increase their EBITDAs by 5 to 10%. And the second question, that more like a debate that has always been there, even internally we have these debates, is that which business is better? Is it better to be invested in the automotive industry via the OEMs or the ancillaries? Is there actually one business which is better than the other? And with the increase in electrification trend, this has only become a much more heated debate. I know you were probably expecting more data to give some kind of conclusion, but it's actually quite relative in that sense. So I've tried looking at the data in multiple different ways, whether the market is saying that the auto ancillaries are a better business, or whether the fundamentals are saying that as well. And when I look at the market data, if I look at the share price returns, yes, in the last 4-5 years, auto ancillaries have done significantly better. but we'll find many reasons throughout the course of the presentation as to why exactly in the last 4-5 years ancillaries have done significantly better. But in a gist, the automotive OEMs actually have not had any kind of significant volume growth in the last decade. Whereas India has become more of a manufacturing hub, and hence for ancillaries, the exports have also created some further growth lever to their business, which has helped them outperform the domestic automotive industry. And even on the fundamental side, it's largely been similar. So I had a look at the numbers based on the gross profit returns over a long period, a 10-year period. It's largely been in a similar kind of bracket for both ancillaries as well as automotive OEMs. So just how has the industry evolved till date, right? So we have 4 distinct phases. So you have before 1982, when the market was still closed, and you had just 5 players at that point in time, but largely it was all imports, and there were long waiting periods for the outdated models that existed in the Indian car market at that point in time. And hence, even for ancillaries, there was no significant domestic manufacturing at that point in time. In 1983 to 1992, when the Indian government and Suzuki formed Maruti Udyog, things got a little better, but especially in 1992, post the liberalization and the delicensing, that actually helped, and there were more JVs and more companies that were willing to set up ancillary businesses in India. And then you have from 2020, that's when actually till now we've actually been trying to gain the technical know-how from the JVs as well. So that the entire phase till now has been more about learning how to develop these kind of technologies and how to do them more efficiently. We've had largely either technology transfer of JVs in the last 20-30 year period, or you have companies like ZF that have, or even your bearing companies. So they are subsidiaries of the global MNCs. And or in terms of family connections, there were some entrepreneurs who started off businesses because they either knew the manufacturer or the promoter of the OEM. For example, Endurance Technologies, their big break was given to them by their uncle Rahul Bajaj at that point in time. And obviously, based on their own merits as well, they have now grown to the scale that they have now. But at that point in time, that big break was given to them by their connections. So in the blue bars, you have the share. It's just based on the number of ancillary companies in India. So you have about 64% of Indian companies or Indian promoter-run companies in India, whereas they contribute to only 32% of the revenue of the total automotive ancillary industry. Whereas in JVs, which are 21% of the volume, they contribute to 47% of the total industry revenues. And you have foreign companies as well, which are 15% in volume, but 21% to total revenues. So actually, if you if you were to assume even a 50-50 JV in terms of the companies that are existing in India, then about almost 45% of the revenues are directly going to the global players. And then on top of that, you add the royalties, which can go as high as 4 to 5%. So almost 50% of the revenues made by auto ancillary companies is actually going to your global players. Another interesting data point is how fragmented this industry really is. You have only 13%. So apologies if you are not able to read this, but you have only about 13% of companies that are generating revenues over 1,000 crores. So that's how fragmented this industry is in that sense. So just a few macro data points. So the industry as of FY22 was 4,20,000 crores or 56 billion, which is about a 6% growth from their FY19 numbers, which was the peak in terms of the volumes for the auto OEMs till date. And this is despite all the challenges, the shortages in terms of semiconductors, or degrowth in the domestic market, or even the fact that we've not had actually it's been led by exports and aftermarket largely for the ancillary companies. And if you just look at a crude data point in terms of the 1800 unique car parts that are going into the vehicle, and you divide the 4,20,000 number by 1800, or you roughly get an average market size of for each product at about 300 to 400 crores maximum. So that's how small each product actually is, and hence the fragmented nature of the ancillary industry. So yeah, this is data from CM, where you can see that in 2018-19 is where the peak was made for the automotive OEMs in terms of volumes, and they have not recovered back to those levels till date. So you have passenger vehicles that are still 9% below the FY19, CVs which were about 29%, three-wheelers about 63%, and two-wheelers at about 36.4%. And even in terms of exports, none of the segments have actually done well except for two-wheelers, who have actually managed to outgrow their 2018-19 peak. So even though there's been degrowth in the underlying industry, the ancillaries have performed better in the last 4 to 5 years. Just some more additional macro data points, how the industry is divided. So you have 25% of revenues or the industry coming from engine components, 15% from suspension and braking, drive, transmission and steering is about 14%, and 14% is electricals and electronics. And in terms of OEM segments, 44% is contributed by passenger vehicles, whereas LCVs, MHCVs contribute to about 21% cumulative, and two-wheelers are about another 22%. Yeah. Coming to the Indian aftermarket. So again, this is one of the few sectors within auto ancillaries as well that has actually grown compared to their FY19-20 peaks. This is also largely, so if you see the ACMA presentation, they state out some of the reasons is that there have been more vehicles on road which have been used far longer. So you need more parts to continue to run them longer. Increase in demand of the second-hand vehicles. In fact, in US, there have been instances during the entire COVID phase where the price of the second-hand vehicle was much more than the price of a new vehicle of the same model. So that was actually quite a rare occurrence. There have been increase in commodity prices that have actually led to the total revenue increase as well. And the changing automotive ecosystem, which has led to emergence of new channels like online e-retailing and multi-brand outlets. So even OEMs today are trying to use more digital channels and trying to cut down the middlemen as much as possible, but they can't completely cut them down, especially in the case of two-wheelers. And exports, and in terms of exports and imports, we've largely always been a trade deficit country. But in FY22, because the exports have really started to pick up, we see that for the first time we made a 700 million trade surplus in India. And your drive, transmission and steering alongside engine components continue to dominate both segments, your exports as well as imports. So that's roughly 54% of all exports and 49% of imports. So your higher realizations were a key factor in for growth in both imports as well as exports. And in terms of the share of imports that we continue to have from other countries to India, you still see China remains the biggest source, which is about 30%. So despite all the anti-China sentiments, we're still importing about 30% of the auto ancillary components in India. And this is quite difficult to displace the entire supply chain for the automotive companies. So your China, South Korea, Japan, Germany and USA would be the top 5 destinations from where we would be importing, and they would account for roughly 65% of our total imports, whereas the top 10 countries would be 85% of total imports. So, what is it that generally makes people believe that this is a tough business? Are there a few factors, why people maybe think about staying away from these businesses? So, some of the reasons that I could come up with were largely your asset turnover. So, I've taken the gross block asset turnover. So, I've taken a few companies. Again, there might be some selection bias, but I've tried to ensure that they're from different sub industries. So, you have. You have Balakrishna Industries, Asahi India, and Endurance Technologies, Harsha Engineers, and Rolex Ring. So those are the 5 companies I've taken in this data point. And you will see largely the gross block asset turnovers range between 1 to 2.5 times at best. And a lot of the companies are actually between 1.5 times as well. So it also depends on how asset heavy some of these businesses are. So generally, you will see them tilt towards a little more towards being a asset heavy business. And one data point easily that you can see, even though Gold Plus is not an auto ancillary company per se, but you can make a direct correlation to Asahi India, which has a dominant market share in the automotive glass industry. So there are in the Gold Plus DRHP, they point out how there are high barriers to entry due to the capital intensive nature of the industry. What they say is that to set up any single line or a factory, they need to set up a minimum capacity of 500 to 600 tons per day. And the cost of that is roughly rupees 1 to 1.5 crores. So basically equating to about 500 to 600 crore of minimum capital investment. And in order to have a full-fledged portfolio of products, you should invest in at least 2 lines in a single location. So that directly makes the minimum investments to 1200 crores. And when you compare to the size of the auto ancillary industry, where only 13% are over 1000 crore revenues, it's a huge number. Even in terms of some tire companies which have been around for decades, you will see. So if you see, this is the 10-year cash flow from operation, how they've utilized it. So just looking at this red bar, about 90% of that of their CFO has been plowed back into capital expansion. They've had to resort to borrowings and issuance of shares also to fund some of this capex while they continue to be dividend paying companies as well. So yeah, some of it might have come through dividends as well. But CAD generally, if you think about it, in the last 20-30 year period, they've not been the most disciplined in terms of most financially disciplined company in the tire space. You can consider MRF as one of the most more disciplined companies. And when you look at their cash flow utilization also, you will see that still 80% has been plowed back into capital expansions. And in comparison, when you look at the automotive OEMs, they've actually been free cash generating machines more or less. So Maruti, despite lower profitability, so we saw the EBITDA per vehicle actually dip from 67,000 to 35,000 or so. Despite that, they, in the last 5 years, they've generated an average free cash flow of about 3,000 crores a year. Hero has generated 2,300 crores on average. Mahindra and Mahindra, the standalone entity, has been able to generate about 1,800 crores on average. Even Bajaj Auto has done fairly well. So all of these guys have actually done very well in terms of free cash generation. Also, obviously, one point to note here is that none of these OEMs have had to invest in more capacity expansions because they've not had any volume growth. But still, the point is that they've been able to generate huge amounts of free cash flows despite the lower profitability. Another point that makes the entire business quite difficult is that some of these businesses are SKU intensive. So if you have a look at Balakrishna Industries, from FY17 to current date, they've actually increased their total number of SKUs from 2,400 to 3,200. And you have to maintain as many SKUs as possible so that you can give variety to your customers as well. And only then can you play across different segments. For example, even in Harsha Engineers, this is one data point that they had shared during their IPO. They have about 3,700 steel cages, whereas Nakanishi Metal Works, who has only operations in the steel cages, has about 4,000 plus SKUs in that segment. Whereas Harsha Engineers is the only one who had steel cages and brass cages. And they have 3,500 brass cages as well. But Manu Yantralaya, which is another local competitor, has only about 2,000 SKUs. So this gives Harsha a distinct advantage to be able to compete in both segments. And when you look at Rolex rings, the SKUs range from 25 millimeter diameter to 900 millimeters. Whereas some of the local competitors are either too small in terms of diameter, so catering to an entirely different target audience, or you have Ravi Technoforge, which was recently acquired by Ratnamani Metals. So they have 40 millimeters to 400 millimeters. So it's not easy for them also to scale up so quickly and have the kind of portfolio of products that is needed to compete effectively. Yeah. And one other point that makes it a tough business is if they happen to be asset light businesses also, they might be working capital intensive. So if you here I've taken three companies. So you have Suprajit Engineering, SKF India, and Bharat Forge. So your cash conversion cycle as a percentage of sales, it comes to about 2 to 3 months at the very least. And when you compare this to automotive OEMs, they all have negative working capital cycles of up to 20 to 30 days at least. So in contrast, it makes ancillaries a lot more difficult business because they have to maintain the inventories at their end. Especially in the automotive industry, they follow something called the just-in-time inventory model. So OEMs try to have as less inventory at on their books as much as possible, and this forces the ancillary companies so that there is no stoppages in the entire supply chain to keep inventory on their books. So this makes it a little more difficult for ancillary companies to be able to bring down the total cash conversion cycle as well. So is it all just bad, or what is it that makes auto ancillaries a good business as well? And so a recent phenomenon, basically, for those who are Star Wars fans, they'll probably understand the reference as well. So for auto OEMs, it's very easy to gauge when there is a disturbance in the supply chain. And the most prime example, which everybody will be thinking of, is a semiconductor shortage. And recently, Maruti put out so the parent company put out a slide deck wherein they've spoken about how many vehicles were lost production is there per quarter over the last 5 quarters. And this is about almost 350,000 vehicles that they could not produce during this high demand period. And looking at the EBITDA per vehicles of about 34,000, that's easily about 1,200 crores of EBIT that they lost out on. So honestly, this picture really resonates with the auto ancillary industry. It's because neither the OEM nor the ancillary can actually succeed without the other. And no matter what happens, they have to keep servicing each other and ensure the other's profitability as well. So it can't be that OEMs take on all the glory and let the ancillaries fade away as well. Because any critical component supplier, especially if they were to have any kind of problems, it would at the end of the day hamper the OEM supply chain, and they would not be able to produce all the cars themselves. In fact, as per a recent Mahindra & Mahindra conference call, what they mentioned, so anybody who's tracking Mahindra would know that some of their models like XUV 700 actually have waiting periods of up to 1.5 to 2 years. And questions have been asked to them, why haven't they been raising capacities since so long, especially when they have so much visibility. And having long waiting periods can be detrimental to the company as well, because you might see some more cancellations as well, as people may get frustrated or just switch over to another model. So what they responded is that the problem was not at their end. They had the cash on their books to expand their capacities, but even the supply chain has to be ready. Till each and every component supplier is able to meet up with the higher capacities and are ready to supply that on time continuously, they cannot go in for a capacity expansion. So both of them have to move hand in hand. And so this is another interesting thing. If you see a lot of auto ancillary IPOs recently, they've been sharing this kind of data. So this is from Sona BLW Precision Forgings, where they share how many years each of these OEMs have been a customer with them. So Mahindra and Mahindra has been with them for 23 years. You have TAFE, which has been there for 21 years. So these businesses, these companies don't easily switch suppliers once once you're there with them. This is from Sansera Engineering. So I'll just read it out to you. The 20 years they've been, HMSI has been, or Honda has been with them for 20 years. Bajaj has been with them for 25 years. Yamaha for 20 years. Maruti for 30 years. And Stellantis for 10 years. So the relationships with these customers is quite long. But one thing to also keep yourself aware of should be that at the end of the day, just a long relationship with any of these customers is not the only thing. The share of business should also grow, and the customer should also succeed for you to be able to succeed with them. And another data point is the long gestation period. So this is an interview of Mr. Suresh Kumar Podar from Mayur Uniquoters. So in 2014, this interview was done, and where he talks about trying to get approvals from GM for their products. And he also mentions that actually in the automotive industry, it takes at least 1 to 1.5 years to get approved. So the gestation periods are long, especially if you're setting up the kind of capacities that you have to, and if they're a capital intensive business, that itself might take you 1.5 year to set up a factory at the very least. Then you go in for approvals for new customers, which is another 1.5 year, and then you ramp up your production. So basically the entire gestation period can be quite long. So what are some of the growth strategies or competitive, or what are the sources of competitive advantages some of the auto ancillaries try to develop over their journey? So the most basic one would be the lowest cost producer. If you're the lowest cost producer, it's very difficult for any other competitor to displace you. As an example, so again, another point would be India as an exports hub. And this also ties in with your lowest cost producer. So if you see the share of exports revenue for BKT, it's always been north of 80%. So their strategy has been largely to sell the off-highway vehicle tires to European markets and North American markets because India as a location is actually the lowest cost producer, and they're able to sell at a differential of 10 to 15% minimum as compared to the global competitors. So this makes it, and this is also why they've been gaining share in the global market. So this would be one of the few ways to develop a competitive advantage. So it could either be the labor cost in terms of some of these businesses, or the fact that steel in India may be costing lower than global markets, and so on. And now another point that helps us become a manufacturing hub is that in terms of the volumes of the automotive industry, we've actually started to grow, and we have large enough volumes. Earlier, the volumes were quite insignificant for ancillary companies to set up manufacturing capacities in India, because they would not be able to use it in India at all. Now they have a domestic market also to cater to, and an exports market. So just some of the examples. So you have in the last 1 year period, so you have Schaeffler India, who's setting up a 300 crore facility in Tamil Nadu. And just 2 weeks before, this is from Timken India, they're setting up a 600 crore capacity for cylindrical roller bearings. And both of these, while they will also be used for domestic purposes, they will be also exporting some of these capacities. Another source of competitive advantage could be the diversification. We all know that the automotive industry is quite cyclical in nature. So taking example of Suprajit from 1985. So when they started in 1985, they had a single segment which was two-wheelers, a single customer that was TVS Motors, a single product that is mechanical control cables, single location in Karnataka, and a single brand. Now over their journey, they've been able to diversify into multiple different segments, multiple customers, multiple products, and so on. This actually helps them to take care of the concentration risk as well, and also grow profitably and avoid the cyclicality of the industry. Another example would be Men & Bearing. So this is a snapshot of the latest earnings presentation, where they talk about diversifying into brake lining and brake shoes, which is somewhat of an adjacent product category for them. So again, for them, it's not a high gestation period to get into this business. So they're also trying to get into different products so that they can grow faster than the automotive industry. One of the prime examples for diversification would be Motherson Sumi, who've been doing this for many years now. And they keep giving out these 5-year targets as to how they intend to further diversify. And from their latest earnings presentation, they talk about 3CX10, which is basically no component, no customer, and no country will account for more than 10% of their total revenues. So they have multiple different products, multiple different customers. So some of these may be customer groups, and hence they look large, and no single country as well. So that's been their strategy to try and avoid the cyclicality as well. And another way to diversify has been to foray into non-automotive businesses. And Bharat Forge is one of the examples for that. So they recently got an order for artillery guns of about 155 million. Even Motherson Sumi is another example, or bearing companies are also another example of this. So they're all trying to go into non-automotive businesses as well to continue growing as well as avoid the cyclicality. One thing to note here is that not all diversification may be good diversification. Sometimes it also happens. I remember for Balakrishna, what they intended to do is to set up a capacity in the US, which they immediately withdrew in the next quarter. So having multiple manufacturing locations may be good, but was it good for them to maybe go ahead and set up a manufacturing capacity in US, which would take away the cost advantage? We don't know. Maybe they had a different ulterior motive as well, but from just a layman perspective, maybe not. Even Endurance at one point were thinking of, I think, getting into tire manufacturing, which they then took back. So there are many of these examples, and diversification can be risky, especially if it's not from your core product areas where you don't have any kind of expertise, or you do it via acquisitions. Another way that the ancillary companies try to get some advantage or outgrow the underlying automotive industry is to grow their content per vehicle. So this is basically as a percentage of the total cost of a, let's say, two-wheeler or a four-wheeler. They may be supplying 2%, 3%, 4%, and they keep trying to improve on that. So this can be either through higher realizations or through premiumization of their product. So if I'm selling, for example, for Motherson Sumi, if they're selling a common side view mirror, rather than that selling a camera based side view mirror. So something like that would actually directly lead to some premiumization in content. Or there is some regulatory led increases as well. So, for example, the 6 airbag rule that is going to become mandatory later next year will directly lead to higher content because for all the airbag suppliers. Or you have new products, so automatically you will be selling more content per vehicle. And this is a snapshot from the Uno Minda presentation, where they talk about across two-wheelers how over the last 4 years they've consistently grown their content per vehicle. Obviously, some of this is also to do with the raw material inflation leading to higher realizations, so you also have to offset that. The same in four-wheelers. And when it comes to EVs, there is a flow chart that they've shared where they say they have about 27,300 rupee worth products under production and supply already. Whereas for 3,000, which may be new products, they've already received orders but not yet started supplying. So that takes them to roughly 30,000. And then they have another 31,000 rupees worth of products that are under development. So their total content might increase to 61,300 rupees. Another example is Spark Minda. So they lay out all the different products that they have or intend to get into business for. And again, here they talk about how currently in the legacy content is about 4,000 to 4,500. And they intend to jump to 16,000 to 20,000. So almost 4 to 5x kind of growth in their content per vehicle. So the content per vehicle should also be seen in direct correlation with the price of the vehicle. Is it that just the content is increasing, so you're actually supplying more than say 3, 4, 5% of the vehicle? Or is it that it's growing because of the rising premiumization? So as a percentage, you're supplying the same and the total content in terms of absolute values are increasing. But another question that would come to mind immediately is, if it's the former, where only the content is increasing and the value of the vehicle is not, wouldn't there be too much concentration risk for a single from a single supplier? Especially now where OEMs have understood the fragilities in their supply chain and want to de-risk themselves from a single supplier, which could potentially harm them down the line. So I believe that there won't be any supplier who will continue to do 100% business. Maybe in certain products and certain niches that might happen, but overall, they will always try and maintain dual or more suppliers to de-risk themselves. But at the same time, they also see some benefits in consolidating their supply chain. This is largely because sometimes the freight cost can be significant for getting different components from different locations. Whereas if you're sourcing it from a single supplier, from a single factory, you actually end up saving on that freight cost, which actually adds to their bottom line. One other way that ancillary companies can get some competitive advantage is the strength of the balance sheet. So Motherson has been doing that for several years, and they've been using their balance sheet to go in for more acquisitions and diversify also, and at the same time get into different geographies, different customers, gain access to different customers or different products as well. So here the strength of the balance sheet may also really matter, especially in the case of a capital intensive business. Distance from consumer. So when I just spoke about freight, this point really matters here, because some of these components are really heavy in nature. So for example, some of the forgings or tires or even your glass, these can be quite heavy in nature. So transporting them over longer distances just adds to your freight cost. So for example, for BKT, pre-COVID, their freight cost used to be about 4 to 5%. And recently, due to the surge in transportation costs and so on, these have jumped to over 10%, and in the latest 3 quarters, it's actually been 14% of their total revenues as freight cost. So, being as close to the consumer can really matter sometimes to save on some cost, as well as to gain some competitive advantage to your competitor against a competitor. And that's why you will largely see that in terms of manufacturing locations for most of the ancillaries, they will try to be as close to the OEM as possible. And also keeping in mind that if exports is one of their strategies, they want to be in one of these clusters so that they are close to the ports as well. So a lot of points have to be kept in mind when they're deciding to expand and set up a new factory. Another point is regulatory actions. Again, this is from the Gold Plus DRHP, where they talk about anti-dumping duty. Same thing has been there in the tire industry as well. So there is some level of protectionism by the Indian government towards ancillary companies, without which some of these ancillary companies would not be able to compete at all. So if you see the time period around 2013, glass manufacturers had it really difficult because the cost of the selling price of the float glass really fell, and they were not able to compete, and they went into losses at that point in time. So you have anti-dumping duties from countries like Malaysia, Iran, UAE, Saudi Arabia, and Pakistan for the glass industry currently. Some other kind of regulatory actions that we've seen in the recent past is BS6 transition, that has actually led to almost a 20 to 25% kind of cost increase for your automotive vehicle already. And on top of that, you have 6 airbags which may become mandatory. But some beneficial policies are also like the production linked incentive scheme that may help put up more capacities, and you're seeing some of those capacities being put up now. Or the FAME 2 policy, which has actually created a surge in EV demand over the last 2 years. And the rising penetration that you see in a lot of categories, especially EV scooters, is largely due to the FAME 2 policy. But it's not just all on the ancillary end that these regulations matter. One of the reasons that the domestic ancillary companies have been able to compete and thrive is also because of the duties that are there on importing vehicles from the global markets. Because most of these vehicles have been designed abroad, and they could have, with some minor tweaks or so, they could have been imported to India. However, we have used car imports which attract about 125% in import duties. You have completely built units of cars if their CIF value is more than 40,000 or petrol engine is more than 3000 cc, they attract 100% duty. So, which makes it difficult for global OEMs to export to India. And that's why you have more domestic manufacturing firms in India, and who also wish to have a more local supply chain. So while I couldn't come across concrete data points to suggest that there is a shift happening in terms of usage of organized spare parts from organized players. But some of the reasons that I could think of that this makes sense is that now you see from OEMs, they have 3-year warranties. And during this 3-year warranties, any of us here who have bought a new vehicle would not even think of going ahead and buying a new vehicle, buying spare parts from a third party vendor who's not authorized to sell that, because that would just void our warranties. Then you have higher complexity in vehicles and parts, which has made it difficult, especially with more and more software coming in your vehicles. The software integration also matters for a seamless experience in the vehicle. So you don't want to mess with that and have fake parts put in the vehicle sometimes. As we spoke earlier, rising digital channels for organized players. So one data point, if you would like to see, is in two-wheeler companies especially, they've been giving this data out in the conference calls where they talk about what the spares revenue is for each quarter. And when you see that as a percentage of total revenue, that has now jumped to about 13% kind of levels. And these are generally much higher profitable businesses for them, largely because they are selling genuine parts, and it's a lot more trustworthy for the consumers, and they have an established brand name and a network as well. Rise of third party aggregators. So by this I mean companies like Go Mechanic. So if you go to Go Mechanic website, they say that they are selling genuine spare parts sourced directly from the OEMs. And later, if they were to actually tie up with companies, the OEMs, to become authorized resellers or service centers as well, that would actually be a huge advantage to both companies. And why exactly? So till now, we all know that Maruti has enjoyed a competitive advantage because of their deep service network. No other OEM has been able to match that. And now, if you have such third-party players who are able, if they're able to generate a pan-India network and have and be present even in rural India, that will actually allow for other OEMs to be able to tie up with them and provide the kind of service quality that their cars or their customers deserve. So that could be a significant shift that could potentially happen in the future, and definitely something to keep in mind. I spoke about the spares revenue for the OEMs. And last point, which is a little more obvious, is that currently there's been a shift towards more premium vehicles that are being sold, like your SUVs and so on. And the more you spend on a vehicle, you don't want to go and buy and save, 100 rupees or 1,000 rupees also on a specific spare part, because you've already spent, say, 15-20 lakhs on a vehicle. You don't want to just put in a fake part. You want an authorized part. So something, again, a lot of questions could be raised. Why in India, despite having the volumes, we don't have any kind of innovative R&D? Why in India we don't spend behind creating new technologies? So this is again another article which is an interview for Mr. Ivy Rao, who's an industry veteran and one of the architects behind Maruti Suzuki's R&D program. What he said is, traditionally most Indian component makers did not focus on in-house R&D. For every new technology, they have looked at their partners. Some component makers have collaboration running into huge numbers. However, some of the Indian manufacturers are taking baby steps in this direction. This is largely because India did not have the kind of volumes for people to test here. Secondly, the kind of vehicles that are being sold, because India is a price conscious market, it doesn't make sense for the ancillary companies to do too much R&D and sell these parts, because some of them would really actually start off in the premium vehicles and then are being adopted as the cost curve improves for those spare parts. So further in this article, Mr. Ivy Rao continues to say that there's a declared strategy to follow Europe, even on emission standards. Since most of the vehicles are designed overseas and local manufacturers work with them over there, so when they come to India, they ask Indian manufacturers to tie up with those local suppliers. And hence, JVs have become an instrumental in this business. And that's why you see companies like Motherson Sumi or Minda Industries having so many JVs collaborating, trying to get those technologies. Something that the Indian companies have done really well and innovated on is the process level R&D. They've actually managed to develop some of these products in a much more cost efficient manner. So this is one of the target areas for the auto ancillary companies, which helps them bring down the total cost structure. One of the prime examples is Endurance Technologies. Yeah. So just to summarize, how would one really analyze an auto ancillary company, in my opinion? So some of these points to be kept in mind is capital allocation, especially when it comes to diversification. It's very easy for them to go wrong, and it might sound very nice in the beginning that they will de-risk themselves, they'll be able to have so many different levers for growth and so on. That can actually go wrong as well. And considering that the industry is capital intensive in nature, working capital intensive, it could easily go wrong and create a drag on their financials. Market size and scalability. This is again something to be kept in mind, because we saw that on average 300 to 400 crore market size is not too large. Some of the components are large enough. So can the company continue to grow? And even then, what is historically, how have they grown? Is it through acquisitions? Is it through internal product development, or what is it that they've done? So some of these can actually help you guide as to what steps the company may take in the future when they reach some kind of saturation point in the current product portfolio. Market share and defensibility. It's of critical importance for OEMs to be able to defend their market shares in the cash cow kind of businesses. If in their core product areas they're not able to defend that, or they need continuous reinvestments, it's not likely for them to go in for a diversification so soon. They need to be able to defend that market share only when they are sure that they'll be able to generate cash flows from that business, should they probably think about diversifying into other businesses as well. Balance sheet strength, again, considering it's a cyclical industry, it's always best, in my opinion, to have a good balance sheet strength to withstand any kind of downturns, especially unforeseen circumstances like COVID. And lastly, valuations will also obviously matter as an entry point into some of the auto ancillary companies. Obviously, in the last 4 to 5 years, we have seen the valuations rise, maybe justified, probably because they've now been targeting exports, the aftermarket has been doing well, and so on. And the underlying auto industry has not done that well. But still, valuations have to be really kept in mind when you're investing in any kind of company. And also the fact that the majority of these auto ancillary companies actually fall in the small cap kind of a company. You have to be sure about the corporate governance as well. So some of these factors should really be kept in mind when you're investing in a auto ancillary company. Thank you. Any questions?
We'll take questions from the live audience first.
Hi. My question is, what would be the market share number for organized and unorganized market players in this industry? So if you can throw some light on those numbers.
Sure.
And how do you see the industry growth going ahead? As in any specific number, if you have evaluated this industry, what is your expectation of how these numbers will get improved going ahead?
So coming to your first question, in terms of what is the number between organized and unorganized, it's actually quite difficult and will depend product to product. So some products are more easier. So for example, for Mayur Unicoaters, they would say that the leather, you will have a lot more unorganized players. Whereas in tires, you may not have so many unorganized players. So it's not a single number that can be shared. And hence it's a little difficult for me also to quantitatively show that there's been a shift towards organized. But some of these points, when you think about it, it just makes intuitive sense that there's been a shift towards the organized sector. Coming to your second question, again, I'll refrain from saying any kind of numbers or projections in that sense. But yes, there's, in all likelihood, the auto ancillary companies will continue to do well, largely because India has become, with the kind of domestic volumes that we now provide, global companies are seeing that this is a preferred location to manufacture as well as export globally. So and they give them the base of the domestic revenues as well because of the volumes. So you are seeing increasing investments towards that as well. So some of these reasons definitely ensure that ancillary companies continue to do well over longer periods.
Hi, excellent presentation. First of all, the question that I have is, considering that this is the ancillary business, as you said, is a very capital-intensive business. Point number one, and point number two, it's also very export-oriented, which means that the developed market obviously is moving faster than say an emerging market like ours. Now, with EVs being the future, we don't know how far in the future, but obviously it's there. How does that change the dynamics as far as this industry is concerned from a growth runway perspective? Because I'm sure it puts in a lot of uncertainty for many of these companies, especially I think I saw another slide where you talked about the engine block, and transmission being the significant parts in terms of value.
Right.
But those are the two parts which are going to get significantly impacted by the transition from uh, internal combustion to electric. So any thoughts on that?
Yeah, sure. So when in a lot of companies, some of their you have to actually see it product to product, right? Tires, for example, they're not going to go away whether it's an EV or a ICE engine. So there might be some incremental quality levels that may be required in terms of noise, vibration, or so on for EV cars, but that only adds to the value of the product. In some products like bearings, for example, what they mention, so when you see some of the presentation by the parent companies, they will mention that the total number of bearings in a vehicle will actually reduce, especially on the engine side. But the kind of the quality of the bearings that will have to go into a EV vehicle will actually have to be much better, and because of which the value component will actually increase. So there may be a offset in terms of volume versus value as well. So you have to see it really on a product to product basis. When it comes to the engine components, which you rightly pointed out, that currently that's one of the major component categories in India. You will see that over time, shift towards say batteries. So you have these upcoming EV specific ancillary companies as well, who are working on batteries, working on motors to improve them. So those may also replace the engine specific components. But engine specific components is not something that will go away so easily in the next even say 5 to 10 years, because even after we've reached 100% penetration, you still have to service the vehicles which have been on road and just sold say today. You have to service them for the you have to service them for the next 10 years at least. So in that sense, you won't see these companies immediately fade away. And some of these companies like Amara Raja Batteries and so on, they have been investing in, because they're also cognizant of the fact that their business might be fading over the longer periods. So they also need to invest in categories to be able to ensure their survival in the long term.
Hi, very
Hi.
good presentation. I have 2 points. Is that large? I recently spoke to 3-4 companies,
Okay.
and they are all saying that even post EV, they will have a very large aftermarket to cater to.
Right.
That is number one. And almost everybody is looking at exports. Now, most of these companies are not looking at North America and to
Sorry, not looking at?
not to North America,
Okay.
but to the European markets.
Right.
Okay. Now there is a talk that Europe is going through a lot of problem and all that. Don't you think that margins can get squeezed than what they expected when they started a export? That is question number one.
Okay.
Question number two is, I recently met one casting company CEO, and he told me that China plus one, even 10% of the volume comes to India. None of the auto ancillary business is so big that they will be able to cater to it. So then, don't you think it will be an opportunity? While in a short run, every capacity will be full with the orders, in the long run, they will not be able to cater to the demand
Okay.
because of the capex, because they are all scared to put up a large scale plant, or if they want to put up, they will put line 1, line 2, line 3 in a phase manner,
Right.
instead of putting up 5 lines together, because of the past experiences where they have put up lines and they suddenly saw order going away and they were in a trouble.
Right.
So what do you see going forward?
Right. So, coming to your first question on Europe, in fact, that creates an opportunity. Yes, the ancillaries are getting squeezed as well because they have cost pressures in Europe. But what it's doing is, because India inherently is cheaper in some of the products, there's already a, say, 10, 15, 20% kind of a pricing gap. That much of a headroom is already there. And at some point, they also have to understand that there's only so much that the ancillary can bear. Otherwise, it's not possible for them also to do business. So it's not viable. There will be challenges in terms of volumes that could continue for some time, and you may see a depressed market. But that is the nature of the industry, and that's where they have to plan their capacities. And this ties into your second question as well, right? So one of the things that a lot of the auto ancillaries rather do, is that they only put up capacities when they have some level of visibility from the customers in terms of orders. So they may have 1 year kind of visibility, even though the confirmed orders may be only for a quarter or so. So when they have that kind of visibility, only then would they go ahead with the kind of capital expansion. But again, here the experience of the promoter or the person running the business really matters, because, as you rightly said, it is a cyclical industry. The orders could go away at any point in time. If you see any, say for example, ILFS crisis or so on, the orders could go away. Yes. And that's where the experience matters, as to when exactly to do the capital expansion, and when is it time to, use more brownfield measures, or to just try and grow capacity to a level that is not too detrimental to their balance sheet, and maintain that balance sheet strength. And hence, I believe that maintaining a balance sheet strength is of utmost importance to these guys. And only then can they withstand these downturns. In fact, at that time, they can actually use, in case of doing more capacity expansions or planning more product entries and so on, which can actually help them in the next growth phase to gain more market share and so on. So the experience of the promoter really matters here. Sure. Yeah, definitely there will be consolidation that will continue to happen. But that also means that, in the larger, so you have to think about it from the sense that a lot of the companies are still capital intensive, right? So they have to prioritize whether they need to reinvest in their own products currently, or do they want to go and acquire a business. Someone like a Motherson Sumi, at the time when they did their original acquisitions, were quite aggressive. They did not actually have the balance sheet, and if something did go wrong at that point in time, they would not be where they are today. So it really depends on the risk-taking ability of the company as well. And these things really have to be kept in mind. But there will definitely be consolidation, to whether it is to gain access to new geographies, new technology, or even customers. So that will always be there.
You in investing or what?
So maybe I can let the fund managers answer this. Right. No, definitely. I would be quite selective personally, at least, if I'm picking any of the auto ancillaries. And that's why I would need to have some of these. If you see this last slide, a lot of these factors need to fall in line for me to be, this is my opinion, obviously. But again, these things need to fall in line to ensure that these companies are there for the longer term, and they're not businesses that fade away over time. So some of these things really have to be kept in mind.
I just have one follow-up question. In fact, it's in line with what the other gentleman asked. So, he asked about consolidation. So, it's an interesting thought because uh, if I understand right, EVs substantially have a much lower number of components as compared to, and though I know that this is really far into the future, but we also have a very large export market. The question I have is, from your understanding of, you've done a really good deep dive, does that necessarily mean that it should drive consolidation? Because if the number of parts go down, then there'll be a lot of players out there who essentially will not have enough volumes to possibly, or possibly their product may die, and they may be, therefore, shouldn't that as a factor actually accelerate consolidation in this industry in the medium term to long term?
That's quite true that economies of scale will be a big driving factor towards consolidation. But you also have to think in terms of OEM risk taking, right? Because if a lot of their products are being sourced from a single supplier, they will understand there's a risk in the supply chain in case something was to go wrong at the supplier end. So even they would start so even if you acquire companies, they may stop giving orders to that companies as well. So that is also a risk that you would be taking. But definitely in terms of economies of scale, that is a big factor that would drive consolidation. And hence I would say that it will be a lot more selective in nature rather than, uh, uh, across all products. In some of the products, for example, batteries, right now you're seeing a lot of startups, a lot of companies who are entering. But over a period of time, it may come down to largely, top 5 players or so on. So there you will see consolidation, but again, it depends on product to product as well.
Any questions from the Zoom audience? Please unmute yourself and ask the question.
Yeah, hi. So I wanted to know about the infotainment market right there, and also the digital speedometers which are there. So like a company, Precol or say Gabriel are manufacturing these. So how big is that market, and is that growing at a faster pace as of now?
So I don't have the exact market size right now offhand. Can come back to you, but definitely these are trends right now in terms of premiumization, right? So these will help for these companies to give premium content to the vehicles. But something that you need to also keep in mind right now is that over the last 3 to 4 years, the kind of inflation in terms of the vehicles has been about 30 to 40%. And India is a very price conscious market. So for them to be able to push, even if that product is costing say 200, 300 rupees more, there's a price sensitivity for the customer as well. So if that demand, if they're not able to pass those costs to the final consumer, it's not viable to put these additional features. These are all good to have features, yes, but they're not necessary features unless the regulations demand it. So OEMs will always try to cut corners wherein they can save costs and have maximum profitability per vehicle.
Rohil, there is one
Yeah.
question on the chat box. I'll just read it out.
Sure.
How competitive are Indian companies in exports, given that China is still a large exporter and India imports a large amount of components from China?
Right. So coming to again product to product, they have done quite well, and we see that even in the exports chart that I shared earlier, that the exports piece of business has been continuously growing. What had helped China till now is that they were the largest volume market, which allowed for the ancillary companies to set up base over there, cater to the domestic market, and also export. India has now reached those levels. Also in India, the regulations in terms of the vehicles, we used to be much behind in terms of emission standards. Now we've reached a level of BS6, which is at par with the European standards. And again, there are more regulations coming in as well, like CAFE norms and so on. So some of these things are creating some kind of parity in terms of what the vehicles are over here, as well as globally. And that's why the time spent on developing these products, because some of these products have to cater to the Indian market, and then they have to tweak it really to cater to the global market. But now if the regulations are also similar, it's easier for them to export as well, especially if they have the quality. So I definitely see that India will continue to do well, but that doesn't mean that we can write China off. Okay, thank you so much.
Whenever things got rough, I always remember what my father used to say.
Running a business does test a man, my son. There are ups and downs, glorious highs, and sometimes a low that leaves you feeling defeated.
The character of a man and the character of a business are not very different, are they?
Yes, but when the chips are down, we must stand up, dust ourselves off, and motor on.
Volatility. It's a funny thing. It makes you question yourself and wonder if you've made all the right decisions.
Sure, you can question some of your decisions, but stay steadfast on your goals.
Dad always said, there are no shortcuts and no quick profits.
There are no free lunches, are there? There is only one
Right way.
At PPFAS, we think like Rahul and his father. That volatility is a fact of running a business. And buying equity shares is like owning a part of that business. We use value investing principles to manage your money. This means we invest in the right businesses at reasonable prices and for a longer term.
PPFAS Mutual Fund. There's only one right way. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.